Right, good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. I hope our internet holds up fine today. I'm all the way in BE, beautiful day here. You could consider not working, but I've got a very strict boss, so definitely not surfing today. We've heard so many discussions on active versus passive investing, and both camps over various presentations made very strong arguments of why both are plausible solutions for client. Adding to the debate is that of reducing overall fees for investors. And we all know that if you do include non-active or passive funds, it does have a big impact on fees and costs. If you do consider both, the trick then is how to bring all of us together in a sensible portfolio. Here to share their views on exactly how this can work is newcomers to Boutiques on Wednesdays, New Road Capital, and it's my great pleasure to welcome Paul Fouchier, Chief Investment Officer and co-founder of New Road Capital. Good morning, Paul. How are you this morning?
Morning, Eugene. Very well, and yourself? A little bit hot here
Very
in
well,
Pretoria,
thank you.
but otherwise good.
Fantastic. Paul, thank you so much for joining us this morning. Really great to have you on Boutiques on Wednesdays for the first time. Really looking forward to get a bit more insight into your business. And then obviously the topic that I introduced, how do you combine non-active and active in a sensible portfolio? You guys have been doing it with great success. And here to share how you do that with our audience.
Perfect. Great. Thanks, Eugene. Thanks for the intro. And thanks, everybody, for your time today. I know it's obviously the end of the year, and you're probably quite busy trying to finalize everything before the festive season. So all the best with that, and I'm sure it'll go well. But it's been quite a crazy year. But yeah, we're quite excited. So we run at the moment, we run 6 funds, but we're quite excited to talk about our newest mandate with you, which we launched in March this year. We launched the platform fee in March this year. It's called the New Road BCI Enhanced Opportunities Fund. And it does precisely what Eugene is talking about. So what we're trying to do is we're trying to bridge the gap between active and passive investing. So if you look, specifically at traditionally what the sort of nuances are between them. I mean, obviously active, you're focusing more on tactical asset from an asset allocation point of view. You're focusing on tactical asset allocation. You're trying to generate alpha through stock picking. That's the whole point of active managing. But in order to do that, you have to kind of look quite different to the market. So you run the risk in the short term of having a tracking error. Obviously, if you have positive tracking error, like if you're beating your benchmarks, great. But you often that comes with negative tracking error as well. Obviously, there's a distribution around that, and then obviously generally higher fees. And if you look at the passive side, you've got more of a strategic asset allocation play. So your purely passive multi-asset type funds will be strategic asset allocation based. So kind of set it and forget it scenario. They're not looking at tactically shifting. They're trying to get the returns just purely through beta. So usually, the most passive you can be obviously your market cap exposure. They will generally obviously have a lower tracking error because they are tracking the benchmark that they're meant to track. So you'll have low tracking error if the fund is constructed properly, and then lower fees that come with that. So what we're doing is we're saying, look, there's benefits to both, and there's good aspects that you can take from both. And with modern day sort of products in the market, specifically offshore, you can actually combine both and get a really good portfolio. So what we're looking at is, firstly, if you look at the sort of primary aspect of what we do at New Road Capital, we're a quant-based manager, and I'll get into the details of that a little bit later. But most of our IP and all of our modeling is really around asset allocation. That is the most important and fundamental starting point for us. So what we do is we sort of combine a bit of active and a bit of passive aspects towards our asset allocation, and we really run a very systematic asset allocation strategy. So it's not purely strategic in terms of a set it and forget it, just whatever happens in the markets, you've got your asset allocation and you just rebalance that the whole time. But it's also not purely tactical, which is where you're looking at market movements and you're trying to buy low, sell high, take advantage of market movements, what a lot of the active guys are doing. We use a systematic approach, which I'll talk a little bit about later. Obviously on alpha and beta, so we're using both beta generators in the portfolio, as well as thematic tilts, which we'll cover some of those exciting ones a little bit later, some of the ones that we like, some of the themes that we pretty positive about in the market. But so we're using beta in order to essentially just get the market return, but then using those thematic tilts to try and generate alpha. And we think that, especially in a more efficient market, as the markets have become more efficient over time, we think that using thematics instead of trying to pick individual stocks is actually a superior, from a risk-adjusted point of view, it's a superior strategy in our view. You've got less idiosyncratic risk, less stock-specific risk. You can reduce your tracking error, which is a big part of our process. So bringing out our tracking error management under control. So you're not going to have pure like passive tracking, but you're not going to have this sort of active all over the place either. You're going to have something in between, and we're quite cognizant of how we manage that tracking. And that's really for behavioral as well, dealing with, all of our funds, we focus on retail. So at the end of the day, you've got a client at the end of that, a retail client, not always sophisticated investors. And, tracking error sometimes with the active fund can create problems when you as advisors are talking to your clients. So, and then obviously bringing into the benefits of that, because we have quite a systematic process, and we don't need armies of analysts analyzing stocks specifically. We can focus on a lower amount of thematics, and we can keep our fees quite low. So our overheads are low, and we can keep our fees quite low. So what kind of informs this? What philosophy? Why would we do this, and why do we think it works? Really, there's two main aspects. The first one is, so there was a seminal paper written in 1986 by Brinson, Hood, and Biebauer, and what they did was they looked at a whole bunch of, actually when they did the study, they were looking at pension funds, and they looked at a whole bunch of pension funds in the US and said, what are the main determinants of the variance in the returns of these portfolios? Like, what is actually happening in the portfolio? Is it stock picking? Is it market timing? What's going on? And what they found is about 94% of that variance contribution was actually asset allocation. And only about 6.4% was either stock picking, market timing, those kind of strategies, using derivatives, all that kind of thing. The main thing was actually just straight asset allocation. And it's quite, if you think about it, it's quite intuitive, because obviously the correlations between assets are a lot lower than the correlations within asset classes. So in other words, it's much more important that you were in, let's say, offshore equities, when offshore equities did well, than what offshore equities you were in, were you in, Nvidia or Intel, for example, would be the example. So locally you could say, well, BHP or Anglo, they're both mining stocks. Like if you're a stock picker, you're going to try and pick your favorite one, but it's much more important that you were in mining stocks when they did well, for example, than which one you were in. So what we do is we take this on and we say, okay, well, so that's our starting point, asset allocation. We build modeling around that. We use a lot of, then once we've got the asset allocation, we use building blocks to build that out. So we'll either use, like I said, purely passive market cap based segregated mandates in the portfolio, or we'll use low cost ETFs that we can get overseas, And that's the beautiful thing about offshore markets. They're much more dynamic markets than locally. They're much bigger markets. And there's a lot of ETFs and interesting things you can do in the ETF space now that you couldn't do even 10 years ago, 20 years ago. The costs have come down quite drastically. And I mean, you can see, some of the ETFs that we use in the portfolio, and I'll speak about some of them a little bit later. But for example, S&P 500, if we go directly to BlackRock, we can get that for 7 basis points. Even more exciting things like, let's say semiconductors, which is a theme we like, talk a bit more about it later. You're getting that at quite a low cost, much lower than you could even do 10 or 20 years ago. So you can get access to these baskets to still look for your alpha generation without having to pick stocks, which is the important thing. Now, how does this translate into costs? So what we did was we ran just a costing. So the fund is a multi-asset high equity fund, enhanced opportunities fund. So it's really a balanced fund. It's a moderately aggressive mandate. And what we're looking to, and what we did here was we just took our platform fee class and we compared it against all the other sort of platform fees across the high equity mandate in the country. So you've got your purely passives down here, and then you've got your like purely actives up here. You've got some broker funds in here, but you got sort of the majority of your portfolios will sit between, I don't know, 1.3 to 1.8, maybe on an active level. Our total TRC in our portfolio sits at 92 basis points at the moment. So that's all in cost. That's management fees, transaction costs, VAT, everything at 92 bips. That's on the platform fee class. So if you want to go straight into the platforms, that's what you'd be paying. But we also more than willing, we're always willing to talk to people, negotiate on fees. If you're running model portfolios or funds of funds and things like that, always happy to talk around fees, based on assets exposure and things like that, asset allocations to us. So, but just the straight platform fee class is 92 bips. So you can see we sit down here, we're more effective than about 90% of all the funds out there. So you know, a lot more cost effective than your purely active funds over here, but still aiming to generate alpha. So we aiming over time to do better than the passives. So it's a nice blend. So that's the first aspect, was this portfolio, this asset allocation aspect to portfolio construction being very important. The second part is that actually looking at passives, even if you just look at a purely market cap weighted passive investment, they actually do quite well. So a lot of people think passive is like the average you can do over time, but it's actually not. It's actually a very high-end performer. So maybe some of you have heard of SPIVA, but what SPIVA does is it stands for S&P Indices versus Active. And SPIVA every 6 months, so S&P does this, that every 6 months they do these reports, and they do it geographically, and they say, okay, over a specific time period, what percentage of actively managed funds will beat their benchmark? They use their own benchmark. So in South Africa, they use the S&P South Africa 50, which is essentially your top 50 stocks, very similar to your top 40, but it includes sort of the top 10, what we would call the mid caps in that space as well. And over the last 10 years, only just over 4% of actively managed equity funds in South Africa have actually beaten this benchmark, just a purely passive market cap weighted benchmark. So it shows you the benchmark would actually be, over the last 10 years, the benchmark is like a top 5% performing fund. You might say, okay, but maybe the last 10 years was like a big market cap run or whatever the case may be. They've actually run these, SPIVA's run these reports for 20, 25 years, and the numbers are kind of consistent through that time period. The reason we put the 10-year in here was because we could get the nice picture on the map. So that's why we put it in here. But numbers are quite similar across the years. If you look at Europe, same thing. So versus just the straight S&P Europe 350, the biggest 350 stocks in Europe, only 7% of active funds have outperformed that over 10 years. And if you look at the US, just the S&P 500, only also just under 8% of funds, and that's over 15 years, because we get the chart on 15 years. Only 8% of funds have actually outperformed that as their benchmark. So it shows you when you're combining passive and a strong asset allocation strategy, you're still going to get really good returns before you've even started trying to generate alpha, if you can keep your costs down. So before we get on any further, I just want to show you. So as I say, the fund is new. So just to talk around performance, and unfortunately, you know, I can't show you intra-month returns, but like as I said, the fund was launched in March, and we've got up till end of October performance here. Obviously, we had a little bit of a sell-off in September and October, but you can see over this time period, substantially ahead of the benchmark, which is just the South African multi-asset high equity average. You can see in just 8 months, we're about 1.7% above benchmark, but it's unfortunate that I can't show you November, but I can talk about it. The fund in November is up 6%. So we've had a big run this November. And if you go and look, I mean, I'm sure you'll have exposure to your own data sources. You'll see our funds are up around about 6% month to date so far. And that's really off the back of those inflation numbers that came out of the US. I don't want to talk too much macro in this presentation, but we do follow macro quite, and it's part of our process. But yeah, so the fund doing really well. So over the last 8 months, we're talking probably about 5.5 to 6% up in quite a choppy market, quite well ahead of the benchmark as well. So that's the overall fund. And then if you look at our offshore equity carve-out, which is quite important to us because that's where we try to generate most of our alpha, is actually offshore, using the offshore thematic based ETFs that we bring into the portfolio. This is where we want to be generating the alpha. Since we launched the fund, if you take our offshore carve-out and you benchmark it against ACWI, the reason we benchmark ACWI is we use both emerging and developed market exposures. We're sitting at about, so this is end of October. It's actually up in November, but as of end of October, you know, quite substantially ahead of that benchmark of ACWI. So we're quite happy with that. And this is predominantly just using passive exposures and thematic-based ETFs, so no stock picking at all. So just to talk a little bit, so I mean, we're quite happy with the returns. You might say to me, okay, well, you know, this is only an 8 month track record that you have here. You know, I mean, you know, how's this going to play out going forward? So we run, as I say, very quantitative-based strategies. So we look at in-sample historical data as well as out-of-sample historical data to make sure that we're not overfitting or data mining or anything like that. And then we also run tests going forward. So like forward run tests, basically. And across all those three, as well as with the reality, there's quite a big correlation between how a portfolio should look relative to a benchmark, and it's playing out exactly like it should. So, you know, before we bought the fund, we had a picture of what we wanted the fund to look like, and it's playing out in these last 8 months. It's done precisely what we've been hoping it would do. So the real world data, the real fund performance versus both out of sample and in sample back tests, as well as our forward modeling, kind of, they all talk to each other. So it's quite well. So you know, that's encouraging for us. We do a lot of statistical tests, make sure our models are accurate. But if any of you would like more detail around that, if you're interested to talk about that, we're more than happy to have a lunch and chat around that as well. Just to give you a little bit of talk around the team. So the three of us that manage the team at the moment, as I said, very quant-based. So it's myself. I'm actually a chemical engineer by training, got my honors at Tux in engineering, then went on to do my CFA. I've been in the investment industry for about 13 years now. I'm supported by Garrett and Mike. So Garrett is also actually, funnily enough, a chemical engineer, also from Tux. Just a coincidence, promise you. He's also got a master's degree in finance and investments from Wits Business School. And then Mike, he builds a lot of the modeling. He kind of handles a lot of the modeling. He's got a kind of investments all the way through. So he's got his honors in investment management from Tux, and then also a master's in finance as well from Tux. Both on their way. So Mike's done level 3, and Garrett actually recently just wrote level 2 last week. So very quant-based team. And how we build, so getting into the actual asset allocation, how do we actually model the asset allocation? So if you look at our process, we really look at a very robust process. Sorry, my lights just went off here. We look at a very robust process in terms of running portfolios. So what we're really trying to do is we run a whole bunch of Monte Carlo simulations, and we're looking at probabilities. So for example, how do you most effectively build an outcome with the asset allocations that you have? So you can see there's quite a difference between an optimized and an unoptimized portfolio. So it's not just about returns, but it's about how do you build the optimizer in the best way forward. So how do you get the returns in the best way forward, and the mathematical relationships that can sort that. So what we look at is we use a probabilistic model. So we'll look at many different futures, hundreds of thousands of different potential futures, both good, medium, and bad. So pretty much everything. And then we bootstrap different portfolios through that. So we essentially force hundreds of thousands of different portfolios holding different asset classes through that process. So you've got all these different portfolios running through all these different potential futures. And then what we're doing is saying through the cycle, which portfolios do the best. Okay, and now most of our IP in this is actually in what's called our dependency structures, or our copulas. There's a lot of maths that goes into this, because if you look at different asset classes, so if you have, let's say, bonds and local equity, let's say, those will have a correlation over time. That correlation will have its own distribution. So that correlation changes over time, but also depending on your type of market, those correlations change. Generally, what happens is when you get times of market sell-offs, like times of pressure and stress in the markets, correlations go to 1. So you'll see when asset 2 does really badly, asset 1 tends to do really badly as well. And that's not really modeled in most models out there. Whereas if you're looking at good markets, the distributions are much more, the correlations become much lower. So there's a lot more distribution. So these correlations move around, they have their own distribution, and that distribution actually has quite a fat tail on the left. Meaning, yeah, because you want to, because like think of COVID. Everything sold off in COVID. It doesn't really matter what you model in terms of your correlations. Everything just goes to 1. Everything just gets dumped. Whereas in a good market, you've got things performing well at different times. So what we do is we take this into account in our portfolio construction and put a lot of work. We do a lot of testing around this. So a lot of very robust testing around this. It's predominantly the majority of our process. The three of us, when we run these quant models, is looking at this and making sure that matches reality. Then what we do from that, so if you just look at an output, so like I said, we run all these portfolios. We've stripped out them here so you can see them. Otherwise, it would just look like a gray sort of blob. But you can see here you've got return, and here you've got drawdown. We actually manage against drawdown. We don't manage against standard deviation. So we don't manage against volatility. The reason being is we think that behaviorally, it's more important to protect on drawdowns as much as you can than on volatility. Because monthly volatility, especially on the retail side, clients don't care about the monthly volatility as much. They care about the drawdowns. That's the real thing. When you start going into market pressure and tension, what's happening on the drawdown side? Monthly volatility up 1%, down 1% is not as important. So what you've got here is, if you've got all these models, so you've got all these portfolios. So all these would be different portfolios. Okay, through the cycle, they mean returns through all these different futures. Okay. So it's a probability-based path, basically. So you can see some of these portfolios are really bad. You're not really getting a good return, and you're getting big drawdowns. It's just a badly constructed portfolio, basically. But you've got these top portfolios here. So what we do is we take out of all these, we take the top 1% of portfolios in terms of returns, because we want to maximize those through the cycle returns. And then what we do is we do a further optimization where we optimize for what's called a Kalmar ratio. Kalmar ratio is different to a Sharpe ratio in that it's your return divided by your drawdown, your maximum drawdown. So take your annualized return through a period, divide that by your maximum drawdown. That would be your Kalmar ratio. And then we optimize for that. Like I said, we don't use Sharpe. So that would essentially be how we get our asset allocations. When would we change our asset allocations? As I mentioned, we're quite systematic. We only change asset allocations if our long run views on an asset change. So we're not doing tactical shifts. So if the market, let's say equity markets get sold off by 10%, a lot of active managers would, try and buy and increase the equity exposure. We wouldn't necessarily do that if our long run return assumptions have not changed. And you might say, well, if it drops 10%, doesn't your long run return assumption change? No, because you're assuming a point ending. And you can never assume a point ending because of the volatility of the asset class. So you've always got a range. So even if you're 10% down and your end range is your end result is within that range, your expected return actually doesn't change. And we've actually done a lot of modeling on this. Cheap markets don't mean good returns necessarily, and expensive markets don't mean bad returns necessarily going forward because of the nature of the volatility of the asset class itself. Asset classes move just in 1 week, can move a couple %. So it's very hard to, a lot of people think the future's a point. The future is not a point, it's a probability distribution. So yeah, without getting too complicated, that's how we think about it. So we won't be doing as much asset allocation changing as a purely active fund, but we'll be doing more than a purely active fund. So it's not a set and forget. It's just we'll change things when our long run assumptions change. Good example would be bonds. Bonds went from 11% to 7% yield. Obviously, our long run assumption is going to change quite a lot there. We'll rerun the models, redo the asset allocations. So talk about thematics. So once we've got the asset allocation, we construct the portfolio then. And we talk about, and we use thematics, a lot of thematic exposures offshore. So we use a combination of passive and thematics. What that does is it helps us manage our tracking error, and it helps us keep costs down as well. And if you look at it, if you go back to that Spiva report, the reason why a lot of fund managers in an efficient market don't actually beat the market is because the maths is actually against them. And there's a thing called the Pareto principle. It's the 80-20 principle. And that really applies to all markets over all periods of time. And if you just take the year to date, this is a couple of months as of May. So year to date as of May, it's just an example. You can see the S&P 500. So the top 20 stocks in the S&P 500 at the time were 30% of the index, but they made up almost all the returns in the index. So if you're an active manager and you're trying to pick stocks in the S&P 500 as your benchmark, that's your universe, let's say, and you're not picking an adequate quantity of those large caps. So for example, this would be a large cap movement. You're going to be behind, and that's the problem, and going forward, it might be another minority of stocks that gets all the return, but you always have that Pareto principle. You always have the minority of stocks in an index actually bringing most of the return in that index through time. So statistically speaking, as an active manager, it's hard to consistently pick the ones that are winning. Whereas with passive, you've got exposure to the whole basket. So what we look at with the themes is we're trying to look at, these are some of the themes we own. We own US tech, we own semiconductors, we own nuclear energy, for example. You either want to be high in the innovation space. So for example, you want to be looking at, let's say take social media historically, or the internet historically. It's almost impossible to forecast the earnings opportunities that come from that space because of the innovation. So you can't actually see the runway in front of you because there's so much innovation in the space. So you either want to be in a space like that, where we think AI and semiconductors are in that space now. We think that's a future secular, let's call it technological trend. Or you want to be very left on this, where you want to have low interest in a theme and you want to run that theme through high interest. So you want, as the interest in that theme goes up, you want to capture it. So for example, something that's low interest is nuclear for us right now. We'll talk about that just now. And something that's high innovation is semiconductors. If you look at like renewables, solar and wind, there's a lot of hype in that, but I mean, it's already in the price. So those stocks are very expensive. There's a lot of interest and actually not much innovation in those technologies. I mean, if you think about wind turbines, I mean, they're a bit more, the way you manufacture them is a bit modernized, but I mean, they had windmills hundreds of years ago, running farms. So not a very exciting space for us, but even though there's a lot of hype in that space, so we're looking at the places where you haven't seen that yet. I'm just running in terms of our NASDAQ theme. So a lot of people say, okay, but Paul, like NASDAQ's quite expensive. Why would you own it? So if you just look long run expected returns on the MSCI World for us would be about 11% at the moment. We think US stocks are going to be kind of in line with that. We like EM as well. EM actually slightly higher expected return. But if you take the NASDAQ 5 years from now and you say, okay, you're trading at a premium, and the NASDAQ generally trades at a premium over time. But if you're trading at a premium what you're going to do in 5 years' time. Well, if the NASDAQ from 5 years out from now just priced at the average S&P 500 valuation, okay, so not assuming that it's on a discount anymore. So you've taken away all the blue sky, all the excitement around tech, and you factor in those earnings, you're still going to outperform your average stock market by about 1.5% per year over 5 years. You'll lose a bit on the valuations, but you'll gain it back on the compounded earnings growth. Okay, same for semiconductors. So we really like the semiconductor space. Semiconductors slightly expensive at the moment, but when you take into account those compounded earnings that are coming through, which people forget about, you're doing quite well. And then nuclear is the opposite. So nuclear is quite out of favor, as I've mentioned. But we think on a re-rating and then also on an earnings growth, you're actually also going to outperform there. So if we talk about it a little bit, just in terms of the semiconductors, the reason we like it, semiconductors and the AI, if you look specifically at AI, we've got about a 30% compounded growth rate here that we're expecting over the next up till about 2030. So from about 2023 to 2030, you're talking about 8 times the size, that market. It's just going to explode. And I mean, if you look at that, look at ChatGPT, which is, obviously this, AI language model. You can see, I mean, it took 5 days to get to 1 million users. Whereas if you take something like Facebook, it took 10 months to get to 1 million users. So you're seeing that explosion. And what does that need? What does AI need? It needs a lot of semiconductors. If you're looking at cars, so connected cars, if you're looking at legislation around there, this is what different countries around the world want to do by 2040 in terms of sales ratios of EVs to normal combustion engines. And you look at where we are at the moment, you're looking massive growth. EVs need a lot of semiconductors, connected cars, so smart cars, things like that, massive semiconductor need there. So we think it's still a massive growth opportunity there because of that innovation in those industries. If you're looking at just data centers worldwide, so if you look at 2020, the world used in terms of energy about 24,000 terawatt hours worth of energy. That's what the world used. In 2030, it's expected to be about 30,000. So we're using more energy. But if you look at the data center usage, it's going from 5% to about 21%. So it's going from about 1.2 thousand terawatt hours to about 6.3 thousand terawatt hours. Data centers obviously using a lot of semiconductors. If we tie that into the nuclear energy, so you've got all these nations around the world, and they've got their emissions targets, and everyone's kind of sort of been focusing on wind and solar. And I think after what, with Russia, Ukraine, a lot of these governments have become a lot more pragmatic. You can't focus on unreliable sources of energy if you're really serious about cutting down carbon dioxide. You can see, I mean, these are the rates at the moment, and these are the targets where these economies want to get to over the next couple of decades. Wind and solar is not going to do it. What these governments are finding, and they're becoming more pragmatic, is around nuclear. Now, there's a lot of negativity around nuclear, which I'll talk about now, but really we like the space. We think that the future of nuclear is actually quite high if governments are serious about getting to sort of greener sources of energy. The US actually this year, a couple of months ago, just passed the Advance Act, which is actually helping nuclear energy, and they've already started to deploy a lot of nuclear energy projects again. So it's reducing the cost around there, to creating incentives. So they want to increase their fleet. If you look at Germany cancelled all their nuclear plants, and now they're trying to, after Russia, Ukraine, they're trying to, starting to bring them back. So, and if you look at it just on nuclear energy in terms of deaths per terawatt hour produced, it's actually very low. So coal is actually the most dangerous in terms of deaths per terawatt hour used, and this includes Chernobyl and Fukushima. They get big headlines, but if you actually look at it, the amount of energy produced, the deaths are actually very low. It's actually quite a safe technology. And if you include that going forward, we're what's called like kind of 3rd generation nuclear now, which is a lot safer than nuclear in the 80s was. So there's actually been quite a bit of innovation in that space. So safer energy plants going forward, better managed, all those kinds of things. And if you look at greenhouse gas emissions, I mean, it's actually amongst there with the wind and the solar in terms of cleanliness. So you've got coal obviously being the most dirty. Oil, natural gas is the cleanest of the 3, but still fairly dirty. And then you've got, you've got this kind of, let's call it the traditionals, solar and wind, your traditional alternatives, your renewables. But nuclear, we think, has got a good space, and it's just there's no interest in it, but we think that interest is starting to jump. And if you actually look at our nuclear holding, when we bought it, it's up about 40% already. It's actually our best holding in our portfolio, and it's still cheap, still looking really cheap. In terms of affordability of nuclear, you can see the cost per megawatt hour of production is actually by far the lowest. So you can see if you take geothermal would be quite cool, but it's really expensive. If you take solar and wind, fairly cheap, that's including the rebates the governments are giving them. But if you take nuclear, a lot cheaper than, say, coal or gas. Also, a lot less land use. So solar and wind requiring a lot of land use. Nuclear requires hardly any land use. I was in the airport the other day, and you're seeing sort of almost dystopian. You're seeing these pictures of these rolling green fields covered in like solar panels. And I don't know about you guys, but I don't think that's very, I don't know. It doesn't seem green to me, because there's so much land use that's needed to actually generate that power, whereas nuclear is much more efficient from a land use point of view, and it's actually much more efficient in terms of its the efficiency of the process of achieving energy generation. You can see wind and solar just highly unreliable sources of energy. Nuclear is actually very reliable. So you're starting to see this pragmatism from governments in the nuclear space. We really like the theme going forward. Just to look at our portfolio, so as I mentioned, it's a high equity mandate. We've got about 65% local exposure at the moment, so about 35% global. Of that, about 40% equity exposure, and that's actually that S&P index, that top 50 index. We actually track that index. So we have a segregated mandate in order to track that index. We keep it nice and tight. Brokerage fees, costing all really low. We sub that out to 10x, actually. Then we run we track the sovereign bonds on the bonds. We've got about 20% government bonds, which I'll talk to about now. Government bonds, we don't have any credit in the portfolio at the moment. And then we've got income, property, about 5%. And then we've got our global, which is where our thematics sit. Got a bit of property, a bit of bonds. We've got some emerging market exposure, just straight market cap based EM exposure. And then our developed market equity is actually sitting in the US predominantly, so S&P 500. And then our thematics, which is our global themes. We like US tech, so we've got NASDAQ, we've got the semiconductors, we've got nuclear, we've got a couple smaller themes in the portfolio as well, which if you want more information about, happy to take it offline and talk about that. But that's essentially how the portfolio looks. So getting a lot of beta and then trying to get alpha through our thematics to really drive that through, and making sure that the cost of the portfolio is really, really cost effective. And that helps you to get that return, and then just managing the asset allocations and making sure you're not making silly short-term calls. Just a note on bonds. So we own, as I said, we own government bonds, as about 20% pure government bonds. And the reason we like bonds is we think there's a very positive asymmetry in the bond market. So we're not just owning it for the yield, but we're also owning it for that capital kick that we think we can get, and that you've actually seen in the last week or two. You've seen part of that kick already, and we think it's still got legs. So if you look, the government bond market at the moment is quite convex. So which means that everyone knows what duration is. So if you've got a duration of 6 and you have a 1% change in rates, you should have an up or down capital movement of 6%. But convexity actually determines how non-linear that is. So if rates go up, we've actually got positive convexity, which means the capital goes down less than the equivalent of if the rates go down, how much the capital goes up. So you've actually got a bit of a protection there on the capital. It's a bit of an asymmetry there, but then you've also got the yield that's protecting you. And the yield, when I did the presentation, it's a bit lower now, but it was about 11.6% in the Orbi. So our base case for the Orbi, if we look at our scenario analysis, is over the next year, if interest rates don't change and the market sentiment around our bonds remains flat, we're going to do 11.6% of our bonds. Okay, that's a good return out of income if you want it. But we also like the potential for capital. We think, we do a lot of macro work, and we do our macro presentations and all that, but we think we're near the top, if not at the top of a cycle. We think if anything, the market might be surprised on the downside. We think reduction rates actually might come quicker than what the market thinks. The market's pricing July next year. We might think it's earlier than that. There's various reasons we think that. But if you got, let's say we're wrong, let's say we've got another 2% to go in rates. Now, if inflation's under control, that's a highly unlikely situation. Let's just say that if our yield curve did a shift up of 2% over the next year, you would still have a positive return out of the bonds. You wouldn't do great, but you'd still do 3.3% return out of the bonds for the year. Now, you can imagine 2% uptick from here. You can imagine what equities are going to do. They're not going to do very well in an environment like that, with markets not expecting it. If you had a 1% uptick, you'd still do about 7.4%. So still kind of like money market rates on the bonds, even with a 1% increase in yields from here. But we think that the left-hand side is much more what's going to happen. If you had a 1% reduction in rates over the next year, those bonds, you're going to get the 11.6% yield, but you're also going to get a capital return. And you're going to do about 16%. And if it goes 2% down from here over the next year, you're going to do about 20% out of those bonds. So we think nice asymmetry in the bond market, and that's why we own the sovereign bonds at the moment. Over the last 2 weeks specifically, that thesis has played out really well for us. So that kind of wraps up the introduction to the fund. I know it's obviously a quick introduction, and thanks for your time. If you look, these are the kind of the portfolio, the lists that we're on at the moment. We're on sort of all the big lists. So your Allen Gray, Glacier, Momentum, 91, obviously BCI as well. If you'd like to talk to us, these are our investment specialists, Louise and Jessica. There's the details if you'd like to have a chat. And we're more than happy to chat to you. I'll come out, have a lunch with you. You know, we have very close relationships with our IFA network at the moment, the guys that support us. And we're trying to build that out. Happy to build a relationship, have a lunch and talk. And as I say, I'm very willing to negotiate around fees as well, if you're running models or funds or anything like that. So once again, thank you so much for your time. I really do appreciate it. And thanks for the opportunity to present the fund.
Paul, very interesting indeed. I mean, very different to what we normally used to. And that's saying there's no such thing as a free lunch. Not true, because you just invited our whole audience for lunch. That was just my contact with you to chat about the fund. Paul, a couple of questions from the audience, and I want to take it back to almost the beginning or start of the fund. When you think about strategic asset allocation or modeling around strategic asset allocation, what is your starting point? And keeping in mind that I see your fund benchmark is the peer group average. Does that anchor you at all when you start with strategic asset allocation, and how often do you review that SAA?
Yeah, so it actually doesn't anchor us. We benchmark against that because it's the realistic. It's just we think the most realistic benchmark to benchmark against. Yeah. I mean, that's what you're getting at. I mean, as an advisor, that's what you can get as an average performance. No, so it doesn't anchor us at all. How we start is we actually do have long run expected returns on our asset allocations. But because we're running the Monte Carlo simulations, we understand that there's a probability band, quite a vast probability band around those. So what we're trying to do is we're trying to say, okay, let's say you assume equities are going to have a 10% return. When we run our models, equities on average will do 10%, but they're not always going to do 10%. And then what we're doing is we're taking all those models together, we're aggregating all those top portfolios together, and that's coming out at an asset allocation. Obviously, we do have our prudential limits. We are Reg 28 compliant. So we're a multi-asset high equity fund, but we are Reg 28 compliant. So we have the prudential limits. Yes. So we have to play within those limits, but otherwise we don't anchor. So for example, let's say our expected return on bonds was 20% on the portfolio. We would actually have quite a low equity allocation in that environment just because we'd be expecting that return on the bonds. So we do we do have dampers in the modeling where, you never want to, because you might be wrong on the bonds. So you never want to kind of throw all the eggs at that scenario playing out. We do have dampers and we use the probability distributions in order to dampen it. But basically, we would have a lower equity allocation because we would feel that we wouldn't need as much because the bonds are going to give you the performance, if that makes sense.
It does make a lot of sense indeed. The next speaks to a question from Jacques as well. And just going back to the beginning again of the structure of the fund. This is a fund, not a fund of funds. So in principle, you can include just about anything, direct securities, ETFs, iShares, and the likes thereof. And I mean, you mentioned quite a few of those strategies as well. I just want to get a better understanding of your active versus passive and the combination of that. If you talk active, it's not necessarily stock selection on your side. It rather speaks to themes. Do I understand that right?
Absolutely, yes. It's all thematic. So we will use, if you look locally, if you look at the portfolio construction locally, let's go back here. Purely, you would think about these as pure passive allocations. So the S&P SA top 50, it's the top 50 stocks in SA market cap based, capped at 10%. So any one stock capped at 10%. It's an S&P index. That's purely market cap. And we don't actually think there's a lot of opportunity in our view to actually outperform consistently in our market. In the equity market. It's a small market. It's pretty concentrated. It's not that liquid. It's shrinking. It's actually smaller in real terms than it was 20 years ago. We think you would have to take a lot of idiosyncratic risks, so stock selection risks to try and outperform that over a long period of time. Not to say guys can't do it. There are good stock pickers out there. Don't want to there's guys that are very good stock pickers out there. great. That's just not what we do. We don't think that we would be able to do it. It's not in our IP. We have a different way of doing it. So we would just have very, very passive exposure there. Also the bonds. So we don't track the All B. We actually track an S&P index. It's basically the All B, but it cuts out the tail. It cuts out all the SOE, like the ESCOMs and all that. There's a small tail on the All B of actual SOE debt that we just remove. So it's just your big sovereign fixed rate index. And then also the S&P property income index. It's just a diversified index of local property stocks, just to get the asset allocation. If you look globally, yeah, so there's no stock picking, it's thematics. So it's either thematics or regions. So right now in our global equity, you'll see we don't have any like Europe exposure, for example. We don't like Europe. We don't think it's where you want to be. There's a whole lot of reasons for that. Demographics, probably the main one. Lack of innovation, another one. We like EM, and we like the US. Where we will have some more global themes, global exposures in our themes. So like semiconductors would be a global theme. So in there would be like Taiwan Semiconductors, for example, NVIDIA, Intel, AMD, all those kind of businesses. But it also looks through the supply chain. So, there's an old saying, you probably heard it, when you were in the gold rush, you could have made a lot of money finding gold or striking gold. But the guys who were selling the spades they all made money, So when you look at this, you want to get the exposure through the whole semiconductor industry, not necessarily just the chip manufacturers. So there's feeders into that. So that's why we buy the theme. So you're getting the exposure to the theme, thinking that theme is going to kind of, it's got a lot of runway because it's highly innovative. So let's go and buy that and then just manage those exposures. So you can see even the thematics, it's about 15% of the portfolio. So it's not these massive calls we're trying to make. We're just trying to build, if we can combine the low cost with a good asset allocation construction and combine some calls and limit the risk around those, we think we've got a good thing going. So yeah, so no stock picking. We could, but we that's not how we think about it.
Exactly. Very sensible, I think, and like I said, very different to what we used to. MSCI exposure sitting at 5%. We've heard so many times, explicit EM can add to volatility, but you guys don't think, in terms of volatility. But how do you think about, developed markets versus EM, and how do you come about the allocations between the two?
So actually, it's quite interesting. So when we run our models, just to talk a little bit more about the expected returns on the models, we run what's called a parity model. We don't assume both local, so all local, developed markets and emerging markets. We don't have a view of which one's going to do better going forward. When we run our models, we actually run them all at the same expected return, because what we're looking for is the parity relationships between them. And what I mean is, so they all have correlations that move relative to each other. Assuming they all do the same return, what is the best way to construct an equity portfolio holding all three? And that's what we use. We don't know which one's going to do better. But what we do know is, regardless of what happens, the way we've constructed it is most likely the most efficient way to construct it. So it's very much, I don't know if Bridge, the hedge fund in the US, they run a parity model as well. I can't think of the name now, but
no, it's okay.
Yeah, and it's similar to that. So it's a parity model. We're not actually trying to take calls. So if you asked us, we do have a view. So our view is that we think emerging markets will do better over the next 5 years, which I've shown you, slightly better, by 1% from a valuation point of view. But when we model the asset allocations, we actually don't take that into account. We're much more focused on efficiency and risk minimization than we are on return. The returns will come. If you construct your portfolio properly, you'll get the returns. So that's how we think about it.
Very interesting. Question from Tian, one of the audience members as well. How do you expect the thematic exposure to shift through time?
Yeah, so at the moment, look, we've got a bit of a macro overlay on this as well. As I said, we do look at the macros as well. We think we're at the top of an interest rate cycle. So we actually want stuff that you would traditionally think of as interest rate sensitive. We actually think that what you've seen is, as you've seen this rising interest rate, these stocks like your semiconductors and even your tech have actually done fairly well through that. Now we think you're through that. I mean, there's been some volatility, but there's been volatility across the markets in general. Once you're through that, we actually think you're on a good thing here if rates start to come down, even if they stay where they are. I mean, so that's the one aspect. We do have some other ideas in the portfolio. We're looking at a couple of ideas at the moment. So they will change over time, but they're not going to change like you would think of in an active portfolio. They're not going to change quarterly, not necessarily change quarterly. They might change quarterly, but they're not. That's not the plan. You know, with active managers, you've got a lot of activity. We're trying to reduce that. We're trying to keep the trading costs down. We specifically look at long run themes. So I've shown you these themes. We think they're the secular trends of the next 10 years. So we'd hold them as long as that thesis we still believe plays out, or, you know, maybe they get maybe they double and they get too expensive and we think, okay, wait a minute, let's back off a bit. But right now we're planning on holding it. So we buy and hold. You know, I think a lot of investors these days, they tell you they're long-term investors, but then you look at their portfolio and it's a portfolio turnover of like 100% or 50%, meaning the average holding is 1 or 2 years. Because we can manage the tracking error around our portfolios, because we're looking at themes and we don't have the idiosyncratic risk, we can actually hold them for a lot longer. So even if they come through tough periods, we can actually hold out because it's a minimal impact on the portfolio. That makes sense. So we do have some other things in mind. We're always constantly looking at ideas, but these are the ideas in the portfolio at the moment. Sure.
We're not going to steal your new idea themes for now. You'll share that over lunch as you
Exactly.
Yeah, exactly. Paul, time for a very last question. You spoke about bonds, SA bonds, obviously very attractive yields. If you just hold it out, 11%. If it's rate cuts, anything up to 20%, very attractive. Do you look at things like credit as well, or do you only look at nominal bonds?
So we do look at credit. So we would put credit into the portfolio, but we think with the way we construct the portfolio, so when you run an asset allocation model like this, you can put credit into it. But what you often find is, depending on your expected returns and where yields are, you can almost get a bit of redundancy in the portfolio. So if it's a multi-asset high equity portfolio, you're already bringing down, by just using normal bonds, you're bringing down the volatility enough. So obviously the credit's low volatile, but it's not giving you, we think if you want it, I mean, we do have credit in our other portfolios, but for the purposes of this portfolio and really keeping the costs down, we actually think to just use the bonds is a better allocation right now. It might change in the future depending on what credit markets do, but for right now, we think because you've got that potential kick in the capital, that we think the bonds. So if you look at let's say a bad outcome, we think you're pretty well protected anyway, because in a bad outcome, you probably get, if you got 2% up from your credit spreads are going to widen. You probably get some defaults on the credit. So a lot of managers taking quite a lot of credit risk at the moment. So they're quite far down the quality curve to get really high yields. So there's other risks you got to look at, not just volatility, but we think the upsides. We think the upsides are really good on the bonds.
Paul, thank you very much for that. A couple of other questions streaming in as well. Unfortunately, we're very much out of time. We will get those questions through to you as well. Tian, thank you for that comment. Hedge fund manager, Paul, that you spoke about. Tian just texted or sent through Bridgewater.
Thank you. Ray Gallion, Bridgewater. Thank you. Yes.
Fantastic. Paul, this has been fascinating indeed. And like I said, a lot of questions coming in from the audience. So there's clearly a lot of attraction to what you are doing. To our audience out there, if you want to get hold of Paul, we can share his contact details. We'll send it through with the thank you note afterwards and the recording, or just get hold of any of the BCI team members and we can get you in touch with Paul and his team. Paul, again, from our sides, thank you so much for joining us this morning. Very insightful indeed to see a little bit more in terms of what you're doing and how you're thinking. It looks like it's working quite well. Time will tell, but I'm sure you'll do that for clients. The audience out there, quick reminder, next week, Wednesday, the 28th of November, we can have a discussion with boutique investment partners around a lot of these issues currently top of mind in a hard landing, soft landing, macro asset allocation, and how to think about all these things when you revise client portfolios or construct a new portfolio. To everybody out there, thank you so much. The BCI team, thank you for setting us up. And again, Paul, from our side, thank you so much for joining us this morning. It's been insightful indeed. And we'll chat to you next week, Wednesday.
Thank you, Eugene, and thanks for the opportunity. And thank you, everyone, for your time. All the best.
Great stuff.